Hi, I'm Keith McCullough, and welcome back to another Real Conversation. I was excited to have this one, because I've never had a conversation with Nancy before, but two, it's a practitioner's conversation about a lot of things that I'd prefer more of you would get to understand, which would include things like the fixed income market, how to trade volatility, how to express inflation bets, stagflation, deflation. Nancy, there aren't many people that I could have this conversation with. Sometimes maybe we feel a little bit lonely, but we can still kind of feel cool together, can we not?
Yeah, peas in a pod today, so this is great.
One of the best one-liners that I've read in a while is that you have this one-liner when I was doing some reading on you. You said, some women love to buy shoes, I love to buy options. And that I think that's a good starting point. Like I think your Wall Street career started most likely, guessing late 90s, and you like to trade, is that right?
I like to invest with asymmetry, and I think I threw that out once as a one-liner about it's kind of unusual to be a woman in the investing world on the portfolio management side, and then it's probably even stranger to be a derivatives expert, and then I'm probably on the extreme because derivatives is kind of like fruit, where there are lots of different types of linear derivatives, which is where the 99% traffic, and I'm in the asymmetric world, which is probably the 1%, where everything that I do has a non-linear payoff, asymmetry. So I'd say I'm a little bit of an unusual creature, but I love what I do, and I find a lot of passion in it.
Well, you did really well with that too. I mean, like your time at Goldman, everyone just saw your resume. I mean, you did the kind of things that you did on the sell side. You generally actually wouldn't find that on the sell side. You brought that to the buy side. You ran, I think, a $500 million hedge fund or part of it, and now you have, of course, your own now. But what was it that got you to just do it differently, thinking differently, like just thinking, like you said, from a nonlinear perspective, or how I like to talk about the volatility of volatility? I think a lot of people are just kind of interested in it, but they don't hear it frequently enough. What got you interested?
Yeah, so I did spend about a decade of the beginning of my career at Goldman, but I was most of my time on the proprietary desk. So we had it wasn't like sell side, because we had no clients or customers or flows. It was really just our group investing Goldman's capital.
Yeah.
And I think the origin of kind of where I developed my style of investing, of using asymmetry and stop lossing at the beginning when you set an investment idea versus later as a form of risk management, like most normal people, is really driven from growing up on the prop desk. And especially, Keith, as you pointed out, joining in the late 90s, Goldman had not gone public yet. It was still a partnership. And, dollar you make is great on the prop desk, but a dollar you lose comes directly out of partners' wallets in a partnership organization. So investing with defined downside and an asymmetric upside was really something I grew up with. I spent the majority of my time on the prop side and rose to become the head of credit derivatives and OTC trading for that team. And I ran the group for 5 years. So it was a great experience. Really loved doing it, but I think it really created that baseline for how I built my career.
Yeah, I mean, a lot of hedge funds, as you well know, maybe not everybody listening in on this conversation knows, a lot of hedge funds were born out of that environment. I mean, a lot of, like you said, pre all the walls being thrown up on the old wall, and that's where we learned. I mean, I came from that side of things as well. When you looked at it though, and you started saying, wow, how could this be in terms of a buy side product, and just trying to get people to the other side of the other part of your career, the big part of your career that you're in now. Like, how did you think about that? There's a big difference, obviously, between managing people and managing your own fund.
Yeah, so I really saw an opportunity to democratize the financial market. And I think the problem with private funds is you have to be wealthy already to buy them. Our private fund had a minimum subscription of $1 million, and it kind of creates more of a wealth gap. And so I saw an opportunity. When I started my firm in 2013, I founded Quadratic, and then in 2019, I launched a first of its kind fixed income ETF, which is really in my mind, doing good for the world, democratizing the financial markets, and giving access to everybody, whether you're a family office, a private equity firm, high yield manager, individual, access to an institutional segment of the market, which is rates, the biggest market in the world. I think most people don't realize how large the rates market is. It's approximately 5 times larger than the U.S. equity market.
Yeah, and it's not just the size, it's the opportunity. I mean, the volatility space of rates and fixed income, to me at least, and it sounds like to you, that's just a matter of fact, it's a much more attractive place, or a more interesting one with less people relative to kind of equity volatility or equity options.
Yeah, it is a less trafficked segment of the market in the world of fund investing, and I do think it's very interesting because there are not a lot of people looking at it, and also with the central bank kind of pounding volatility for the last 12, 14 years, it's a really compelling time because that asymmetry that you can buy in the rates market is really, really at very depressed levels.
Yeah, I mean, it's that would be the understatement of our conversation so far. I mean, suppressed is what it is, but it's also given birth to like what I try to teach people to do, which is trade the risk range or trade the volatility of the volatility. I mean, even in a narrow range, I mean, the options, particularly, and I get this feedback all the time on big things, like TLT, IIFs, like or IEFs, gold even. I mean, which basically trades in the same vol space. I mean, it's amazing. It does amaze people. I get the feedback all the time. Wow, I just made a shitload of money relative to trading some of these equity options I'm used to trading, and the thing really didn't move that much. That to me is an interesting thing, but it shouldn't surprise people, should it?
Yeah, I mean, I do think a lot of investors are using these ETF options to express their view in rates, and I hope more people learn about our eyeball ETF because it's a way to access, I'd say, a cheaper volatility level.
Yeah.
Cost of implied vol inside of the eyeball ETF is 2.5 basis points a day. So it's a lot lower price than other instruments in the market in the ETF space.
Yeah, can we get into that? Like, I mean, I think you've described it as kind of tips plus, but let's just get into the architecture of what you built and explain, like, as simply as you can first, and then we'll get into the weeds a bit.
Yeah, so 85% of the portfolio approximately is treasuries. We use inflation-protected treasuries by choice. We actually like real yield lower more than nominal bonds. We think nominal bonds are pretty expensive, especially given the pandemic and we just spent 14% of fiscal spending of GDP. So there's been a lot of stimulus, and so we think investors are compensated more for the inflation protection because almost uniformly the world is expecting there to be deflation. Therefore, owning the inflation protection is pretty cheap. And then on top of the TIPS portfolio, we add options that are on the U.S. yield curve. And if you think about what the U.S. yield curve is, it's largely a result of an investor's expectations for inflation in the future, right? It's the difference between interest rates between one point in the curve and another point in the curve. Currently, I just pulled up Bloomberg. We look at the 2s10s, which is the difference between the 2-year and the 10-year, and it's 39 basis points. So to put that into perspective, that would be like, Keith, you go to, your local bank and you say, all right, I want to give you some money. Let's look at CD rates. And to lock up your money for 10 years, you only get paid 39 basis points more, so way less than 0.5%. And that's because investors really don't think there's going to be any inflation in the future.
And so how do you actually, and we'll get into, let's just stay on the mechanics of that. So we basically have, to explain this simply to people, you have TIPS, which a lot of people understand, I think, or at least they know what they are. Ray Dalio invented TIPS because he wanted to basically have something that could beat long duration bond managers that weren't protected against inflation. So he created it, got Summers to sign off on it, and voila. So we got that market. But I think people know what that is. But the part of the other 15% are trading the shape of the curve. That might be not too far out there. I think that makes sense. But it's not everyone's expectation, by the way, that like if you were actually to get, there's certain kinds kinds of inflation where the curve would steepen. There are other kinds of stagflation where the curve may not. So, like, how do you think about that? The stagflation versus, I mean, there's a lot of different things we can think about, but actual, what I'd call quad 2 inflation, real growth, real nominal rising. You'd have stagflation, which I think we have now. And then, again, not that my opinions are going to be yours, but deflation is what we just had, which absolutely pancakes and inverts the curve, which it did, obviously, looking back a year at the peak of the cycle as well. So how do you think about those kinds of states when trying to explain your product?
Yeah, so if you separate out the tips for a moment and just put those to the side, the options are unique because they're agnostic to the absolute level of interest rates. All we care is that interest rates widen between short and long dated rates.
Right.
Now that can happen two ways. It could happen, say the economy continues to reopen, we have a resurgence of the virus, come fall, things are really bad, and the Fed has kind of used all their, we have fiscal spending, we have infrastructure spending on the table, and we have policy rates close to the zero bound. The options would likely benefit if we went into a negative interest rate environment where we went into NERP, because that would deepen the curve. So the options can benefit from lower front-dated rates or the market expectations for negative rates, or it can also benefit from a normalization of inflation expectations. And that's really key to highlight that we don't need there to be inflation to do well with this strategy. We just need a normalization of 10-year. The 10-year is totally all risk and no reward, in my opinion, at 64 basis points right now. Like, kind of the Super Bowl case, if yields go to zero, the most you could make owning 10-year treasuries, nominal bonds, is around 5%. Whereas if yields normalize and we have a more risk-on environment, like say we do have a U-shape or a V-shape recovery, so not even talking about inflation, just a normalization to follow the equities and credit market, you can lose, 15, 20% very quickly by owning nominal treasuries. So I think the challenge for investors is a lot of people are running into the 10-year as a place of safety. But to me, the 10-year seems like all risk and no reward at these levels. And IVOL benefits from lower yields because we are long bonds and we can potentially do well with the options in a steeper yield curve with lower front end. But we also benefit from a normalization if the rates market goes more risk on. So I'm not even talking inflation or stagflation, just a more normal environment.
Yep. And it would also benefit, I suppose, rate volatility, no matter what your economic quadrant that you're in, like at least talking in my speak, I think everybody listening to me knows what that is. But again, wouldn't you just be able to trade it as long as you have volatility?
Yeah, so we own options. Whenever you buy an option, you're long volatility.
Yep.
But we're not delta hedging or trading the vol, the difference between implied and realized. We're just using the very cheap volatility to get exposure to the yield curve. So we can benefit from the normalization in 10-year yields, the normalization of inflation. Obviously, if we had stagflation or inflation, that would be great as well. But we don't need that to happen necessarily.
Well, what looks like has actually helped you, whether you thought it was going to work that way or not. It looks like your top 5 ETF returns for the year. Obviously you've captured an environment that a lot of people were not prepared for, but that's why you built your product. Like you said, you wanted to democratize something that people on the buy side understand how to execute. We've seen Treasury bond vol, like the MOVE index, get absolutely crushed. So if people were looking at your product thinking, and maybe to a degree it's because of the ticker, they might be thinking implied volatility or something like that. Actually, on the table that we show our subscribers every morning, I call our implied versus realized table our IVOL premium and discount table.
Perfect.
Oh, you knew that or no? Yeah,
I didn't know that, no.
Yeah, guys, you might pop it up there. But people, when they look at this table, you'll believe me, obviously, Nancy, like they look at that table and they're like, what the hell is that? Can you imagine if they're like, I don't know, whatever people do on the old wall, but it's like that table there.
That's awesome. But so you have IVOL everywhere.
Yeah, it's IVOL, RVOL is
that was not him. That's just coincidence. So I guess it's serendipitous that we're having this conversation.
but just so that the people that follow me that are now going to follow you or already followed you know that the difference, like you didn't actually need to have, like you have actually had suppressed Treasury bond market volatility, if we define that as the MOVE index in particular.
Yeah, no, that's a great point, Keith. We are, the whole fund name, the ticker is IVOL, but the fund name is the Quadratic Interest Rate Volatility and Inflation Hedge ETF. So we don't need there to be inflation, obviously, to do well with the strategy. The strategy's up a little over 12.5% since we listed it in May 2019. And clearly, there's been not a lot of volatility in bonds. There's also been no inflation at all. So we benefit from a normalization in the yield curve and in the inflation expectations market, but we can also benefit from a lot of other environments. Like in the first quarter, the strategy did very well. It actually outperformed gold and some of the other, risk-off trades out there when equities were selling off and credit spreads were widening. And then in the second quarter, we also have continued to do well, even though there has obviously been no fear of inflation or inflation. It's just in the name. So I think people get kind of turned off sometimes where they're, avid, rabid, would probably be the right word.
You think there are some rabid deflationistas out there?
Rabid. Yeah, I said avid at first, but I was like, I think rabid would be a better way. Because Keith, like when you're talking about stagflation or inflation, there's so many people out there who are like, that is crazy. You're out of your mind. That doesn't make any sense. I mean, I'm sure you hear that all the time when you're talking.
Yeah. I mean, I may as well have TLT as a back tat at this point for people to, they'd probably like that because, if you've been long the long bond or gold since Q4 of 18, it's just been awesome relative to a lot of the other options. But one of the options has been something like your strategy. And I'm trying to, I basically, and I wonder what you think about this, because most of the people that subscribe to me know that this is exactly what we've done. We basically went from long duration, as far as the eye can see, going back to when the 10-year was at 3.25, to buying zeros, extended duration bonds. Like I had to teach people how to do that. To getting rid of that, getting rid of the piggish kind of duration and putting tips in with basically something like the 10-year.
Right, no pigs. I like that. That's good. I mean, the reality is people are not getting paid for the risk to own duration right now. And I think a lot of people are thinking about, duration will be a hedge to their equities. And I don't necessarily think that's going to be the case. And a lot of people have that mentality that owning this long dated duration is going to hedge equities. And I think it's just a fool's game at this point, like a hot potato.
What it hedges is deflation. I mean, deflation when the oil price was negative was fully priced in. And that's when you saw the low point, not only in U.S. rates, but in global rates. I guess that's the other question. I mean, on this discussion, if you take somebody like Lacey Hunter, you take somebody who's somebody older than me that could have been bullish on duration for longer. Let's just try something like that. They're gonna stay with that one until they're quite literally dead. And that's an interesting one when you have a cyclical inflation off a cyclical low of deflation. I try to never make that mistake. I guess that's what you're trying to tell people. You can lose a lot of money at that pivot.
Yeah, I mean, I think people who have been bullish on bonds have been right for, in general, 30 years. So if you keep, especially if you're, like Lacey, who's a bond manager, right? It's kind of talking your product and he's stuck with the deflation story and whether he's been right or not, bonds have worked. I think the challenge today is, our fund is long bonds. Remember, we have 85% in treasuries and we have a 7.8 duration on those treasuries. So it's not like we hate bonds, we own bonds. But I think having that very, very cheap inflation protection hedge makes a lot of sense because the market's giving it to you almost for free. With the U.S. yield curve at 38 basis points, like just in 2014, the U.S. yield curve was around 250 basis points, 2.5%, and there was no inflation, there was no stagflation, there was no deflation, there was literally nothing going on. It was just normal to have, you go to the bank, you lock up your money for a decade, you get paid, 2 to 2.5% more. So I think people get very set in their ways sometimes. And I think you can have your duration with the IVOL ETF, but you can also have your hedge in case, this is something we've never seen before, this global pandemic. We've never seen such a incredible global QE infinity all around the world with such velocity. We have fiscal spending going on, and people are ready to get out there, and you can see it in the equity market. The Nasdaq's hitting all-time highs. Credit is super tight right now, but the 10-year is still trading like it's the end of the freaking world. So I know you agree with that. So yeah, I'd say stay away from the ham at this point, to use your what did you call it, pork analogy with the duration.
Yeah.
Is that right?
Oh yeah, that's exactly what I'm thinking. But I mean, there are periods in time, and this is why I never anchor on a prior cycle or some kind of a theme based on the outlook. I mean, I affectionately call that macro tourism. I mean, you and I went to school with plenty of smart people. We actually went to work with even smarter people, i.e. the people that were not only smart, but they could actually make money. There's a difference. And now you sit here for you and I, like over 20 years later, and I don't think that you need to have a prescribed economic outcome. But if we do have a protracted stagflation, there's nobody under the age of 60 who's run money in that environment. I mean, that's the 1970s environment, and I think for your strategy in particular, I mean, you're gonna kill it if that happens.
That's gonna be awesome. Well, stagflation is like death for all portfolios.
You know that, yes, it's the death.
Fell off together, so it's super toxic, and nobody's worried about it at all. But if you your reviewers, if you pull up stagflation on like Wikipedia or just the definition of it, all that stuff is happening now, right? We have lower growth, right? Check. We have a very, very high unemployment rate. Check. We have higher prices in the form of staples with like food and transportation costs, and it's not obviously cruise lines and handbags. It's a different type of stuff people actually need. But we kind of have that textbook stagflation happening now. But the irony, Keith, to your point, is like, literally nobody's thinking about it, nobody's worried about it. And so IVOL isn't just an inflation fund, it's not just a stagflation play. It is, we could potentially do well in a deflationary environment when bonds are bid. It gives you a lot of different options, and I think that's why the market is kind of giving you that compelling opportunity to say, look, we don't really know what's going to happen. There have never been more unknowns, but the implied volatility market in rates, especially this type of what IVOL is crazy cheap. It's 2.5 basis points a day, this type of volatility, which is way cheaper than the MOVE index or swaption vol. And if you're one of those people that think the front end is going to be pinned with, say, a yield curve control where they pin the 0 to 3 year, this vol could potentially more than double. So we think it's a pretty compelling opportunity.
Well, what you get is the market is already, let's just start with what the market's already doing, which is, again, separating the intelligentsia. Again, I try to remind people I had the lowest SAT score in my class at Yale. I know what somebody smarter than me is, but there was a weird thing that happened once we all went to work. I wasn't ranked at the bottom anymore. So you get that delta, and people that just quite literally, they have to pitch, like you said, their own book or their long-term investment product. I think they fail to see that what is the market putting a premium on? Well, the market's putting a premium on your strategy, things like I've mentioned. Well, why is that? Well, because the market is sniffing out an economic reality that is aligned with what we've said, as opposed to the economic reality that people need. And I think that a lot of people generally, if they haven't thought that through clearly, they will at some point, because their account will make them do that. Slide 94, guys, just to show you, we back-tested actually what Nancy just said, and not everybody knows what she just said, which is a fact. Like Quad 3 is horrendous for any equity market multiple, and for, by the way, speculative credit, high yield and junk in particular. It just pounds the multiple of the market, because what it's really doing, stagflation, is that it's crushing the earnings of the market. And that's or the underpinning or the lack thereof of an earnings recovery. On that, like I wanted to, like how do you take, because for me, on this view, the thing that could change my view is the dollar. And dollar, when I look at dollar undergoing a potentially massive phase transition here from bullish since Q2 of 2018 on my math to most recently now gone bearish. I mean, that perpetuates the deflation part of stagflation. Do you think about that a lot? Do you trade currencies at all, like in terms of having views on that, or what do you do?
Yeah, no, I definitely think at the end of the day, people need to protect their purchasing power, and it is a global economy, and the value of the dollar really makes a difference. If we look at other, say, emerging markets, when their currency devalued, that was sort of the catalyst to bring inflationary protection for products. Like you have some extreme examples in emerging markets. I don't think the U.S. dollar is going to completely fall out of favor. But I think it's very important for people to be thinking about that, especially it drives me nuts when people think of gold as their inflation hedge. And gold is so sensitive to the level of currency and the rates in different markets. So I feel like people don't know that that is kind of its own beta and actually a bet on currency.
Yeah, people. I think that they're learning. I mean, when you go to the peak of gold, or the peak of actually inflation expectations, would have been really interesting to see how your model did in 2011. Obviously, it did really well, or you wouldn't have been able to launch your own. You wouldn't have become head of everything on the Goldman desk and launch your own fund. So I assume that those returns in 2011 perpetuated the part of the shift. But 2011, I mean, that was the dollar, a 40-year low in the dollar. Inflation expectations ripping. Bernanke would get on straight face. He actually, I went through every FOMC statement. He never mentioned the dollar once. And of course, it's like, oh, there's no inflation. I mean, the purchasing power of the people, get out of here. I'm bailing out my buddies on Wall Street. You're like, that was the all-time high in the CRB index. That's 19 commodities. I mean, how is that not an inflation expectation? Did your view of the world, or did your process help you nail 2011?
Yeah, I mean, I did have a very good 2011, but it's probably not as you expect, Keith. I was actually, although I've been running my own firm since 2013, I was actually a stay-at-home mom for 3 years, where I actually took care of my kids. I think it's, as an investor, the best risk reward in that 0 to 3 period where I stayed home with them. So I was investing during that period, but it was for myself and not on behalf of company.
I didn't know that. So you actually did have the most, in some sense, the most sane part of your market life. Because that was a crazy year. I mean, and this is another question I have for you relative to your strategy, because that's when Bernanke said, haha. Actually, that is one of the people that I would qualify of the class. Like, if we go back to, I think he's Princeton or whatever, like he would qualify probably as the smartest person. Even if he wasn't, he'd probably think he was. So he would say, like, so that's when he basically said, I'm gonna basically what do you call it, twist the curve. And I couldn't believe he did that. I couldn't believe that he was going to do it, and moreover that he actually did it. And that's where you got that wicked steepening.
Hold on, I have to stand up. He pulled that out of his you-know-what, because that was monetary experimental policy from the 1960s. You're talking about Operation Twist.
Yeah.
Operation Twist, they pulled out when, remember Greece, everybody, during the European debt crisis, it started in 11, went into 12 and 13, and they didn't know what to do because policy rates were already at the zero bound, kind of like where we are now. And what they pulled out was this Operation Twist, which was, experimental, like it should have been left for the 1960s, in my opinion. And what he did was basically squash inflation expectations by doing this Operation Twist where they bought long dated, sold front dated, and they flattened the yield curve artificially. And now Powell and Yellen, everybody has been trying to crawl out of this like super flat, the whole system of banking depends on a steep yield curve because banks are short term, they lend long term. And Bernanke, I think, is directly responsible for the lack of inflation expectation and all the direct lending and kind of hawkish lending where you have hedge funds that are lending money to people because they can't get loans from banks. And so I do think the Fed is trying to undo that Operation Twist that was started around the European debt crisis. It really kicked off in 2012, 2013.
Yep.
I think we need to have a steep yield curve to get money from banks and institutions into the hands of Main Street, which I think is what really matters at the end of the day. So I don't think the Fed's going to make the same mistake again. But yeah, I'm definitely with you where I think Operation Twist was a bad idea. It had very unintended consequences, and it really needs to be undone. And they can undo it now by doing yield curve control on the front end, and also by issuing longer dated bonds under Mnuchin to take advantage of this very flat yield curve for taxpayers, the United States.
So you like yield curve control?
I think I don't know if I like it or not, but I think it's going to be a reality for us. I do think the Fed is going to be copying, I'd say, the modern yield curve control from Australia. The RBA implemented it earlier this year on the front end. I do think that's what the Fed has been talking about. A lot of people think of yield curve control a la Japan. And I think for your audience, they should definitely read up about different types of yield curve control, because I don't think the Fed is going to want to pin the 10-year because it will hurt the banking system.
Yep.
I mean, it will also hurt equities. If the 10-year rallies anymore, meaning yields getting any lower, all the risk models in the world that look at the 10-year as a risk-free rate are going to say, ooh, warning, 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 sell everything, sell all equities, sell all credit, and just own long-duration bonds. And that's not what the Fed is looking to do. So I think yield curve control in the front end would actually help the eyeball ETF, because it should make our implied vol be closer to the 10-year, which is almost more than double. And it also should deepen the curve by pegging the front end.
Yeah, people whenever they hear the word government control, they should be scared. I mean, that's my personal opinion, of course. But again, it's not the same. I mean, Japan eliminated the yield curve. There's a difference in yield curve control, Aussie style, and that, just so that people have that straight. I mean, quite literally, that's why Japanese banks, there's no such thing.
They died.
Yeah, they're gone multiple times.
Died.
Yeah, and actually, when I look at, I've been short the financials. Has been my favorite sector short this year on the equity side. It's because I can't see that yet, and maybe that's when I take the other side. I'll eventually go along the financials, but I mean, really the story of banks is now it's their clients that's the problem, and they have no yield curve. I mean, what else are they going to do? I mean, just tell stories about how great Jamie Dimon is? I mean, I don't get it. So maybe Powell does get that part of it. God knows he's going to do everything he can to bail out Wall Street. But I mean, I think it's an important thing that you did was just differentiate the two things and explain what it would mean, most importantly, in terms of how to make money next. I don't know about you, but it sounds like we have this thing in common. I don't like central market planning. But I have to deal with central market planning. I have to try to front run it. I have to trade it. I'm not at peace with it, to be clear, but I do trade it instead of fighting it. How about you?
Yeah, I mean, I'll go back to the metaphor that you used at the beginning about liking to buy options. I think options are very, very cheaply priced, specifically in the rate market, which is what Eyeball owns options in. And there's never been more unknown unknowns, and you just can't predict what's going to happen in terms of whether, this trade war, pandemic, central bank policy, like all of this stuff is unknown. And I think having asymmetry in your portfolio to potentially benefit in multiple environments is what people should be looking for. And I think it's also important to diversify away from just stocks and credit exposure, because they're both very expensive right now, and look for other diversifying assets. For your audience, if they go to the Eyeball ETF website, there's a fact sheet and you can pull up the correlation. Eyeball historically has had, almost no correlation to the main equity indices, to credit, to high yield, even to the VIX. We're not correlated. And so I think it's time where people need to be looking for cheaply priced things for their portfolio, because everything today is very expensive when you're looking at nominal duration or equities or even credit spreads, and look for things that are contrarian and look for things that give you differentiated returns.
Big time. To be long volatility in this environment and long inflation expectations is a must. If you're going to do it with your own money. Now, if you're doing it with other people's money and not really your own money, you can tell people whatever story they're willing to believe. But that, by the way, there is a correlation. I was running the math because I haven't bought it yet, to be clear, because I felt like the honest and credible thing to do is have this discussion with you, figure out loud in front of everyone if I really want to buy it, and I'm going to buy it.
We met for the first time, so it's our first date. So don't worry, I didn't expect you to buy it ahead of time.
No, but if we so we do have impact because we have a large community of people, particularly in the very short term on new ETFs. I know everybody might be chuckling a little bit when they think about some of the things that we bought, like most recently, commodities exposures is another way to express your inflation expectations. But what I really was running was the correlations of your ETF against the dollar going down. And because that's another way to express, again, it's like, okay, does it pick up inflation expectations when the dollar is being devalued and debauched by these central planners? And lo and behold, it does. And the correlation, the inverse correlation being is strengthening. So I would expect that the machine, in all of its glory, because it really doesn't care about what Nancy and Keith does, is going to probably start chasing your ticker.
Yeah, no, I'm excited. It's great to meet you finally. I feel like it's long overdue, especially since we're both based in Connecticut and have this kind of out there view that stagflation and inflation is a risk and is underpriced, because the world right now is so uniformly into the deflation forever camp that taking a contrarian position, the market's priced efficiently. So I think I'm glad we finally met. I feel like it's good timing, and it's also cool that you have our ETF ticker all over your daily report. I feel like
Well, now I can actually explain what it does. So thank you for doing that. In 36 minutes we did. So let's, if you don't mind, I'll go to the questions. There are a fair amount of questions coming in here.
Absolutely.
And again, if you have questions for Nancy, please pop them in the queue. You're going to get up. She doesn't get many down votes. She gets a lot of up votes. I'm not surprised about that at all. Let's just go to the one with the most votes already. From Ashley, it looks like, in light of immense fiscal and monetary accommodation, what are fundamentally strong markets over the? Actually, this one is parts. Maybe answer that. I think you've already answered it. But what is the strongest part of the market that you look at? I think people generally, Nancy, when they're asking that question, they have an equity market in mind. But that's where you want people to get away from, actually.
Yeah, I mean, I think it's important to have diversification in your portfolio. The reality is that most, regular people, the bulk of their net worth is tied up in their home and real estate. All professional real estate investors, for the most part, they all head trade, whereas regular people just sit there long real estate. So I think looking at something like iVol to potentially do well when you have a normalization in elongated yields and when mortgage rates move higher and house prices are less affordable is attractive. Mm-hmm. Also, if we get into a situation where we do have, say we go into depression or say the Fed has to pull out negative policy rate, we can also benefit from the bonds that we own in the portfolio as well as the steepening from cuts in the front end. And I think also vol is so cheap in interest rates. I think a lot of people, when they think of volatility, they think of equity vol.
Yeah.
Anything that has an options market has volatility. So whether it's, corn, soybeans, commodities, currencies, ours is curve volatility. That's what we own. And it's a people need a fund to access that market because it trades over the counter. It's more of an institutional market, but it's very cheaply priced, much cheaper than TLT or equity ETF vol or even swaption vol or treasury vol. So it's one of the cheapest asymmetries that you can get out there, in my opinion. And I think people really should have it in their portfolio as a way to hedge against potential real estate corrections, equity market corrections, and also potentially from a normalization of inflation expectations, whether that's stagflation or the gasoline that the central banks around the world have just poured on this economy.
Mm-hmm. And so people understand that, like when you're trading, effectively trading the curve. So if we were only to go from 40 basis points, 10s, 2s wide to 60 basis points, that'd be plenty good enough for you.
Yeah, when we listed the fund in May 2019, you can pull it up. The U.S. yield curve was about 15 basis points.
Yep.
It's had obviously lots of bips and bops in between, but currently it's 39 basis points. The fund's up a little over 12.5%. We don't always make money. Obviously, investing is risk, and there are certain environments where IVOL could underperform regular treasuries. But the yield curve typically doesn't stay inverted for very long, and we think it's a pretty compelling opportunity, given it doesn't look like your stocks and your credit that you probably already have, to Ashley's point, in the portfolio right now. It's something different, which I think is good and is something people should be looking for right now.
Yeah, the yield curve, when it inverted, you're right. It was like for a cup of coffee. But again, it led the economy. It nailed it again. The curve doesn't invert while you're in a recession. It leads that. And that absolutely nailed it. I didn't know that you nailed this call, but a gentleman by the name of Jorge says, Mrs. Davis, you made one of the all-time great calls suggesting at the tail end of 2017 there was far too much dollars looking to sell volatility instead of actually buying it. What was that call that you made? Was that an equity vol call or no?
Yeah, so I was a speaker at the Sohn conference, and after I gave my presentation, I got interviewed by CNBC, and they asked me offhand, what did I think of the VIX? And I said that I thought the XIV was the best short in the world, and it was probably going to go to zero, which is, for those who know, it was an inverse product. So it was basically saying own equity volatility. And the reason I gave is that I thought a lot of people were using it like Las Vegas, where there was a lot of retail money chasing the price momentum because equity vol had been falling. And it was extremely overcrowded. I was a couple months early. It blew up in February 4th, 2018. I think I said that in November 2017. But and XIV went from about 127 down to, I think the low was around $7. So it wasn't perfectly right. But yeah, it's I think that goes to your, a lot of people are buying gold right now. As a currency, or even some people are talking about Bitcoin and other cryptocurrencies. And I think the point is you don't want to have all your chips on one thing, because you don't really know what's going to give you that diversification. And that's why I think having IVOL to portfolios, especially to replace nominal treasury bonds, is a good opportunity, because it's not like everything else that you already have.
Well, let's be clear. A lot of other things that people have, inverse ETFs, triple donut bang, whiz bang ETFs. Like, I've seen a lot of garbage. You just actually gave a good example of a flaming POS that really got people killed. I mean, how do you see? And actually, Jorge had a second part of the question, which is, how do you see that part of the industry now? And you're obviously competing with it. Like, are a lot of people, basically stepping in front? He says, are people still picking up pennies in front of the steamroller?
Yeah, I mean, I think a lot of people have no idea that they're short volatility inside their conduct. It's from a lot of people use the AGG or the Barclays Ag Index, and a third of that index is, and I kind of I'm like pulling my hair out, being like, what, do you all not remember the global financial crisis? Because mortgages are short volatility, and that's because the homeowner can prepay the loan whenever they want. So therefore, the owner of that mortgage is short that option. And implied volatility, when it increases in the market, it makes mortgages fall in price terms. And so I think a lot of people have no idea that they're short vol inside their fixed income portfolios, which is why IVOL is such a nice completion portfolio. Also, the Barclays Ag has no inflation protection in it.
Yep.
Maybe that for the inflation protected treasuries were created in the late 90s. The Barclays Ag used to be the Lehman Ag, which was created way before TIPS were created. But I feel like IVOL is a really great completion portfolio because it neutralizes short vol that's inside the mortgage book, and it also gives you exposure to inflation plus inflation expectation.
Right. Now you're basically the Gen X version of Dalio, like in terms of how he, and I mean that like in terms of actually just trying to stay ahead of what are, you just explain, I think, some pretty archaic or dogmatic products. I mean, to not have any inflation hedge in a fixed income portfolio when you have a view that inflation is rising, I mean, that doesn't make any sense at all. I mean, so if people really think about it, I guess a lot of people don't really think about it. They pay their advisor and they buy whatever they buy. You mentioned some that have a lot of AUM, obviously. So, like, is that something too? Is that our generation is largely an equities generation?
I'm not sure. I think our generation has been taught that a 60-40 portfolio is a risk diversifier, meaning equities and bonds together. And I think people need to separate in the fixed income space. You know, if you take something that has credit spread risk, credit spreads tend to widen when equities sell off. So if you think you're diversified, but you have a lot of credit, you might not be diversified. And I think if you look at the first quarter of 2020 and you compare it to IVOL's returns, you can see how we outperformed credit and gold and many other things that people had in their portfolio. But at the end of the day, it is an inflation fund, right? IVOL is classified as an inflation protected bond fund. So it doesn't need, you know, Armageddon or the end of the world to do well. It's not a tail fund, meaning you have to have equities and credit be, you know, going down to do well in this strategy.
I mean, it's part of a portfolio that's trying to find exposure to a certain environment. Again, whether it's rip-roaring quad 2 inflation or it's quad 3, what I call stagflation, I'm going to look for more and more ways to express that don't all trade together every single minute, every single week, every single day. And I think that, I guess that's really what the hedge fund industry became. I know you have some thoughts on this too. I mean, hedge funds, they were neutered. You're not allowed to take a net short position or, God forbid, a super net long one unless you're just going to call yourself private equity. But again, you end up in a place where, like, people don't. The hedge fund business certainly isn't able to show the kind of transparency like you have with this product. I mean, I would love to watch people on a hedge fund desk do what you do out loud every single day and show their daily returns.
Well, I obviously, we have some clients who are hedge funds who own the IVOL ETF. You know, I have nothing against hedge funds at all. I think, you know, every investor, you know, deserves a lot of respect. But I would say one thing, Keith, that I'd love to talk about, because I feel like you're a small government guy just from this is the first time we've met. But, you know, a lot of people put all their weight into CPI. Mm-hmm. And you take a step back and you look at CPI, a third of CPI is shelter, specifically defined as rent. And, you know, for investors, credit, duration, private credit, private equity book, you know, rent is kind of irrelevant for the duration risk in your portfolio. So I think having inflation expectations at 39 basis points, which is really, you know, what matters to investors' duration risk, is a much better value than just being locked up to real estate, CPI, or what the government tells you inflation is.
Yeah, that would be an understatement as well. But back on this, on flows, like you're going to be the recipient of this. Guys, show slide 4. Just showing the investment landscape and how it's really changed since, you know, Dalio again introduced tips to the world. I mean, it's demonstrably different. Can you see this, Nancy, what I'm showing?
Yeah, I can see it.
So we're just showing hedge funds assets under management against ETFs and ETPs. You know, obviously, if BlackRock is giving you the outlook on this, the thing's going to double, the black part, not the blue part. And that's another way that I think about it, which is find the ETFs that express the exposure that you're seeking, and buy that. It's got lower fees. And in your case, it's got more transparency. So why would I?
And a lot of hedge funds own ETFs. I actually emailed Ray in the fall when I saw a headline about him losing money by trying to be short treasuries. And I sent him a note and I said, look, instead of, you know, just taking an outright bet on short treasuries, you might want to consider the IVOL ETF for your portfolio, because we give you, I think, a safer way than just being short bonds, especially with the negative carry. And when I was looking at their portfolio, approximately a quarter of their portfolio is actually ETFs.
Yep.
So it's pretty amazing. I think the cool thing about having a product is people can use it however they want. You have liquidity, you have transparency. You know, you can use it as a long-term asset allocation holding. You can use it as a, hey, I need a hedge, you know, in the short term. Hey, I need a place I don't want to own we've seen a lot of investors who own short duration treasuries, and they're using eyeball as a potential replacement for that because we've distributed 30 basis points monthly since we started paying distributions last summer. And owning short duration, typically that segment of the investing world is worried about higher rates. And so instead of just losing a little less by owning short duration, they can potentially make money when we have a normalization in the rates curve. So I think it just goes to show that it's a big world out there. There are lots of different strategies, but we really feel like we're doing something innovative by giving this in a wrapper in an active ETF that anyone can buy on the New York Stock Exchange.
Yeah. For sure. Now, this is a question that has to do with, I think a lot of my subscribers are long tips, as I pointed out, but through the TIP ETF. So there are a lot of questions about that. I'm sure I'm going to set you off a bit on this, but is iVol a replacement for something like that? Is it better than that? Are they two different things?
Yeah, so the TIP ETF is a passive tips portfolio. It's referencing the same passive index that we use inside of iVol. So if you like inflation protection, ours is the passive tips index, which is about 85%. But when we add this very cheaply priced inflation option on expectations, which, if you look at the U.S. yield curve at 39 basis points today, that is trading at a significant discount to break evens or to where inflation expectations are priced based on the CPI. And to my point, I think the CPI is not necessarily, you don't want to have all your eggs on the government telling you what the inflation basket is. The rates market is big. It trades with, institutional around the world. Everybody uses the rates market, and having inflation expectations is what really matters more. So I see it as an enhancement, as a potential tips replacement, so you don't have all your chips on just the CPI.
Yeah, TIP is not a crappy product. It expresses a passive index, correct?
Yeah, it's not. We have the same passive index inside of our product. 85% of my fund is that passive index. We don't use TIP, but it's I don't think it's a crappy product at all. I choose to own tips. I think we just give inflation expectations that are priced at a significant discount as well as just tips.
Which is why I think the simplest way to explain your product, as you've explained it, as I've read it, is Tips Plus. That's the way to do it. Tips Plus. It's a good one. I think that the people are actually they don't understand everything that we have real conversations about, but I think they're starting to get this one. That's a very good thing.
I like to explain it, Keith. Like a lot of people, the name volatility sounds really scary, I think, when it's in the name, but I think of it really similar to a mortgage. A lot of investors own mortgages in their portfolio, and that's an agency obligation coupled with a short option. And I see iVol as a treasury obligation coupled with a long option. Mm-hmm. So I think it's kind of really demystifying what it is and how people can use it. And it's also long-only options. So I think it's in my opinion, a very conservative. We can underperform tips if vol falls below, it's currently 2.5 basis points, or if the yield curve inverts. So it's not guaranteed to make money, and there are risk rewards. But I do think it's a better way for investors to gain inflation expectations, and to potentially benefit from a normalization in the rates market, whether there's inflation or not.
I'm sure that you get asked this a lot, but you could ostensibly create multiple ETFs that has a different mix, where you have 65% of the passive index and your trading on the curve actually is amplified. Is that something for another day, or is that something that you don't believe in?
Yeah, so we the fund is actively managed, so I can, with the options component, we're not tied to a passive index because there is no index out there for the interest rate volatility and inflation hedge that we are on.
Right.
We can tailor the portfolio based on, if vol is really cheap, we will own longer dated options to get more beta sensitivity. Like right now, the average tenor of options is a little over 14 months, and you can see all the holdings are disclosed on the iVol ETF website. So everyone can see it because it's active, transparent, but we can tailor that based on the opportunity set and really act on behalf of the shareholders of the fund.
Mm-hmm. Well, I think that you're hitting on something there too. Maybe to wrap up here, just you explaining it. Like, how many ETFs, first of all, do what they're supposed to do? Let's just start with that. And if they did do what they were supposed to do, has a real person with a real track record explaining it like this. I think that's unique. That's got to be rewarding from, like you said, democratizing and being transparent and accountable. That's something that our industry needs a lot more of.
Yeah, I feel really good at the end of the day with what we're doing and giving, investors access to this market and not being, it's a little harder when you're in that 1%, right? When you're not doing what, it'd be very easy if I ran an equity fund or a short duration high yield fund or do what everybody else does. But I get a lot of sense of pride of doing something different, giving investors more choices, and doing something that I think at the end of the day, people need wealth protection in their portfolio. They need to be able to have a way of gaining income, potentially not losing too much money in a market vol environment. So I think owning volatility long term, but not equity vol necessarily, because it's very hard to carry, is a good thing for the world. So I do feel a lot of pride in what we're doing. Obviously, all investing involves risk. You can't guarantee performance or that future performance will look like historical performance. But I really think with the pandemic, there's never been more unknown. And even if you look at the end of 2018, the rates market, the whole world thought the Fed was going to hike 3 times in 2019. And it just goes to show you how you can't predict what's going to happen, because the Fed ended up cutting 3 times in 2019. And that was even before we had a global pandemic and an inflation, election year coming in, and inflation expectations, squashed. They're on their, nobody thinks it's going to happen.
Yeah, I mean, there are a lot of ways that people change the world, but I mean, it is, and maybe when they hear people like us on Wall Street, they're never really going to quite hear that. But you can change the world if you compound returns after you preserve the capital. Like, that's a big thing. I mean, a lot of people don't have capital preservation at their core, so therefore they cannot compound those returns. And I think that's something that really changes the way that people think about investing. So first of all, thanks for creating this. This thing's impressive. This thing's more impressive than I thought it was, and that was before I was already impressed. So thank you.
Well, it's awesome. I mean, this is our cold meeting. I've never talked to you before. We didn't do any prep, and so in a way, it was kind of really fun because this has been so explorative. Like, I had no idea that you used eyeball all over your materials.
It's great.
So I feel like given your quads, even our name, Quadratic, and your quads, like
I think that people picked up on there's math behind it. That's a big part of it.
Well, I'm so tired of people asking me if I'm a quant fund because I have QUA. I'm like, no, it's quadratic. It's asymmetry.
Yeah. Well, math, rates of change, using volatility. These are the language of a lot of people, thank God, and I do feel that it's a blessing, and I do feel fortunate, too, to have this growing audience where we can really educate people like this, because there's a wide world to learn from, and people like you. I have a sneaking suspicion you'll be back, whether this thing is going up straight into the right or chopping people around, like you said. It's not always going to go one way, but I think people understanding what they're investing in, I think that this conversation, by the way, all of you know that I have no VIG, there's no partnership with Nancy and I. I'm just going to buy her product, and now you know why, okay? So I hope you're good with that, because I like doing it that way. So thanks for having the conversation.
Thanks so much, Keith. It's a pleasure to meet you.
Yeah, it's a pleasure to meet you too. She's Nancy Davis. She's not on Twitter because she's doing her job running the money, okay? So I hope most of you guys and gals can appreciate that and all of her knowledge. I thought she did a great job.